In this edition of INN CEO Talks, I'm joined by Brendan Urich, the CEO of Electric Royalties. Brendan, welcome.
Hey, Stuart. Thanks for having me on.
Let's tell our viewers a little bit about what Electric Royalties is. Of course, you're a royalties company, but the electric part refers to the metals markets that you're in, not rather than electrical generation.
Yeah, we're a mining royalty company, but we do focus on those clean energy metals really required for the transition to clean energy. You know, whether it be lithium, copper, nickel, cobalt, tin, we target 9 clean energy metals, and we're really looking to buy royalties on those assets within North America, Europe, and Australia. That could be domestic sources of supply for these metals. For all the gigafactories, coming up under construction, in those jurisdictions.
So why is it important that you focus on those jurisdictions at this time? Because so often we've been, in those markets, in the electric metals markets, people have looked at other jurisdictions. Why is it now important that we stay Europe, North America, and Australia?
Yeah, well, that's really our target focus. The point being, I think on a couple levels, right? If you look at where the production of a lot of these critical metals is, they're heavily concentrated in, China, Indonesia, the Democratic Republic of Congo, for graphite, tin, nickel, cobalt, respectively. And so you have this really high risk profile in terms of where the production of these minerals is. And so I think there's always going to be, from a safety of supply concern, a reason for having domestic supply. But for a much more fundamental, reason, if the whole point of this transition is for us to reduce our carbon footprint, get to zero emissions, it doesn't make much sense to be shipping, ore from halfway across the world to gigafactories that are going to be up in North America, Europe, and Australia. So, having a domestic source supply that's going to be nearby these factories, I think is going to be a key thing.
So right now we're seeing softer markets. Does the royalties business benefit from a softer market environment?
Yeah, well, so there's a couple sides to it. Right now we're definitely in an inflationary environment. The nice thing is for us, we're not on the hook for capital costs, development costs. So, as their costs go up from inflation, they eat that. We don't have that. And then when groups actually get into operations, our cost on a unit basis, say per pound of copper back is zero, right? Once we do that upfront payment, we never have to pay anything further. So, we're not hurt at all by the inflation and operating costs that you'd see in operators. And in a tough market like this, where equities are depressed, definitely is a perfect time for a royalty company to be going out there, picking up royalties. At the end of the day, we're an alternative financing mechanism, for these groups to move their projects forward. And, when equity prices are, tough, like where they are today, we're saving them more dilution. We're a non-dilutionary financing. And so, yeah, royalties are, poised to do well in this type of market.
Well, tell me about your company and your financial situation that put you in a place where you can be providing this, financial resource to these other companies.
Yeah, so we've got 20 royalties to date. We've got exposure to all 9 clean energy metals that we're targeting. We have cash flow coming out of our producing zinc royalty in the US, which we closed last year. And we've got a number of other royalties that we're expecting to come into production here as we move forward into 2023, 2024. Our next royalty will probably be our Oche lithium royalty. The operator, Sayona Mining's, raised, I think it's over 190 million, in the past 6 months or so. And so they're ready, set, and going to enter production next year. And so, between those, we'd expect to be cash flow positive. So that's a positive development for us. In terms of our ability to finance and get deals done, we've never had more than 3.5 million cash in the bank. And we're very creative in terms of how we put deals together. If you look at our first cash flowing producing royalty acquisition, our cash cost on that was $250,000 on a deal that was, close to $20 million in size. So, we bring in, partners where we need to, and do some, unique stuff. But, definitely in this market, I think there's a lot of opportunities out there. We're active. We're talking to a lot of different groups, and we'll be creative in terms of how we finance those.
So what's your model in increasing your own asset value? Is it because you're going to have cash flow generation through the assets that you're invested in, or
Yeah, yeah.
is there?
So yeah, well, it's a perfect example. I mean, ultimately, we are trying to build long-term recurring cash flows, right? And so, when we buy a royalty, and I'll use an example of a royalty because I think it, that royalty alone makes us undervalued. But Battery Hill, right? We acquired that royalty a couple years ago as part of a package. But let's just call it was less than, but say $500,000, right? And that project has steadily been moving forward. They just put out a PEA. And once that project comes into production, we're expecting that'll pay us, anywhere in the range of US 3.5, up to US 5 million a year. And they have a 47-year mine life, right? So, ultimately, as you have more of these royalties coming into production, they're very long life assets, typically, at least 10 years by and large, and up to 47, like in the case of Battery Hill. And so, our operating costs, like I mentioned, are zero, right, on an ongoing basis. So it's just cash flow coming right off the top into the company. And ultimately, once we have enough cash flow, we'd like to start dividending that back out to shareholders.
What do you say to a potential investor who might look at your stock right now and go, oh, how come it's so affordable?
Yeah, well, look, I think at first there's a lot of education, to the market. A lot of these metals that we're targeting are, kind of not well known, let's say. And a lot of it's really been about struggling to get that size. Until you're a $50 million company, it's really tough to get institutional capital to come in. They need to be able to write a $5 million check, not go over 10% ownership in your company, as well as getting analyst coverage. And so I would say the opportunity is really that markets aren't efficient, and we're just not at that size level yet where we've garnered that increased awareness, increased availability of institutional capital. So if you're not a shareholder now, now would be the right time to join in, because that's not going to last forever.
Well, no. So just to recap, let's talk about some of your assets right at the moment that are closest to production.
Yeah, well, I mentioned that we already have our producing zinc royalty. We're expecting that'll pay us about $500,000 this year. We have an option to increase that royalty, actually double our interest in that royalty. That'll come in August of next year. And then our Oche lithium royalty, like I said, they've raised over 190 million. It's really, the plan is to blend the ore from our project, the Oche project, with the NAL processing plant right next door. So they've already got a plant. They've already got the money. They're fully funded. And they've stated they want to bring that back into production next year. So, that'll be good. I mean, when we bought that royalty, lithium spodumene prices were about 400 a ton, 400, right, a ton. And they've recently hit as high as, 7,700 a ton. So, you can imagine that's a pretty big increase in terms of expectations on cash flow. Beyond that, we have a couple graphite royalties that are pretty near term. One is, on care and maintenance. Shut down because of COVID restrictions when that kicked off a couple years ago. And they've stated they want to bring that back online at double the production capacity they actually did previously. So that'll probably be coming on. They've already had all their product qualified with off-takers. And beyond that, we've got a big wealth of development portfolio. You're looking a little bit more like 3 to 5 years out, but lots of different assets there. Whether it's our Zonia copper asset in Arizona, they've got a PEA, about 500 million pounds of copper in the ground. Should be a feasibility study within a couple of years. I mentioned Battery Hill, our manganese asset. The only manganese district really in North America being developed for the EV space. 47-year mine life. The metallurgy is much more advanced. It's more to, I would say, an FS level. Mont Sorcier, a great iron ore development project where we're getting our vanadium exposure. They've got Glencore as a partner. They're moving towards feasibility. We have our Seymour Lake asset. They just doubled the resource, raised about 70 million going into that. It's a lithium asset in Ontario. So we've got, like I said, 20 assets. A lot of these assets are in development. We've had over 400 million raised in the last 18 months. All that going into the ground on our assets. Moving them forward for us at no cost to us. So it's a lot of exciting stuff coming here. For electric royalties in the new year.
Well, it's a great time to be looking at the company from an investment perspective. I hope you'll come back in the future and give us further updates, because it's quite exciting, all that you have in the works right now.
I appreciate that, Stuart. I'd love to come back on, down the road and keep you guys updated on our progress.
Wonderful. Thank you for your time.